Book summary: What I learned about investing from Darwin, written by Pulak Prasad. Enjoyed the video. Please subscribing to my channel for more great content like this. You'll be notified when I upload new videos. What I learned about investing is a practical guide for investors, particularly those who are self-taught and do not have a formal background in investment theory. Prasad, the founder of Nalanda Capital, a Singapore-based firm, offers a unique perspective on investing, drawing lessons from evolutionary biology. Prasad argues that many professional analysts rely too much on analytical tools, which can hinder their ability to identify companies that provide superior compound growth and downside protection. Instead, he advocates for a strategy that rules out the vast majority of investment opportunities and focuses on permanently owning high-quality businesses. Prasad uses real-world examples, often from his own portfolio at Nalanda Capital, to illustrate his points. He also draws on examples from evolutionary biology, including works by Charles Darwin. Here are 5 applied examples from the book. 1. Bumblebee's survival strategies help us accept that we might miss out on Tesla. 2. An experiment in breeding tame foxes reveals the traits of successful businesses. 3. A small frog's mimicry of the croak of a larger rival sheds light on the signs of corporate dishonesty. 4. The importance of robustness in nature and why you should search for the same attribute in business. 5. How to identify businesses that can evolve in a fast-changing world and remain on top. As is the case with most investors, Pulak has a very clear investment philosophy which he pursues with religious zeal. This philosophy can be summarized in 3 sequential, straightforward steps. 1. Avoid big risks. 2. Buy high quality at a fair price. 3. Don't be lazy, be very lazy. The author has drawn an analogy between Darwin's evolution theory and author's own investment philosophy, which has helped his fund consistently beat benchmark returns for more than 15 years. Mr. Pulak Prasad is founder of Nalanda Capital. Nalanda's core investment philosophy is to be permanent owners of high-quality businesses by buying at fair price and avoiding big risks. They try to invest where the entrepreneur is the largest shareholder and Nalanda can be second largest shareholder. Obviously, there is a lot of detail to these 3 steps. Those details are what the book is all about. Pulak's inspiration for his investment philosophy comes from Darwin's theory of evolution. His love affair with the theory of evolution started with Richard Dawkins' The Selfish Gene, a book recommended by the great Charlie Munger. This book is in 3 parts. Part 1, Avoiding Big Risks. In this section is the most important lesson of the book. A great investor is also a great rejecter. Over a long period of time, success comes not from getting more hits but from avoiding bad bets. This is a piece of wisdom universally shared by almost all the great investors. Prasad introduces the first of his 3 mantras of investing: avoid big risks. Drawing parallels from evolutionary biology, he emphasizes the importance of avoiding catastrophic losses or, in investment terms, the permanent loss of capital. Prasad argues that errors of omission, or missed opportunities, are less detrimental than errors of commission, or poor investment decisions that lead to significant losses. This concept is akin to the survival strategies of species in the wild, where avoiding predators and other threats is often more critical than securing every possible meal. He uses the example of bumblebees' survival strategies to illustrate this point. Bumblebees, despite their ability to collect nectar from a wide variety of flowers, often specialize in just a few types. This strategy reduces their exposure to predators and increases their efficiency, even if it means missing out on some opportunities. Applying this to investing, Prasad suggests that investors might be better off missing out on high-risk, high-reward opportunities like Tesla, and instead focus on safer, more predictable investments. He further advises avoiding businesses with a history of unethical practices, as these often pose bigger risks. In summary, the Avoid Big Risks section of the book advocates for a cautious approach to investing, prioritizing the preservation of capital over chasing every potential gain. This strategy, Prasad argues, can lead to more consistent, long-term success. To understand this, we first need a lesson in statistics. There are essentially 2 types of errors. Type 1 error, when you bet on something which is a bad investment by mistaking it for a good one. Type 2 error, when you don't make a bet on a good investment by wrongly believing it to be a bad one. The key question in an investor's life is this: which type of error can you live with and which type should you avoid? The choice between type 1 or type error is essentially a choice between two investment strategies. Either one, make lots of investments so that you don't miss any of the good opportunities, even if it means making some bad ones, or 2, be highly selective in your investments to avoid bad bets, even if it means losing out on some good investment opportunities. Pulak answers all these investment questions with multiple examples from studies of evolution. They are fascinating to read about and they really get you interested in studying evolution. For the purpose of this summary, however, I have avoided getting into too much detail. My favorites are the silver fox study done in Siberia by Dmitry Belayev and Ludmila Trut and the study of finches on Daphne major by Peter and Rosemary Grant. The key insight from evolution which Pulak uses to answer the investment question: all species have evolved by developing a sophisticated survival instinct. One which believes in avoiding all threat to life at any cost. There are many references in the book. I will use the one about male red deers and their mating rituals. Female red deers called hinds live in groups called harems. The males who are called stags target them for the purpose of reproduction. Often two stags end up competing for the same harem of females for the purpose of mating. In such a case they need to fight to decide who gets to mate. The reward of winning the fight is the chance to mate. Mating is important for the species to survive and evolve. These are the two choices for the male red deer. Type 1 error: get into every fight that you feel you have a reasonable chance of winning. You will win many and get a chance to mate often. In the process, you will also lose a few fights and get injured or even disabled in the process. Type 2 error: avoid fights as much as possible. Even if it means backing out of fights you could possibly win. This means fewer chances to mate. But you avoid any chances of injuries. What does the stag do? Reduce the risk of injury or disablement as much as possible. Avoid an actual fight at all costs. They have developed some very interesting rituals as an alternate to fighting. They start off by roaring loudly at each other to show off their strength. Often this could go on for more than an hour. Sometimes, one deer backs out at this stage. If this doesn't work, they try intimidating each by walking parallel to each other with stiff legs. This shadow fighting is followed by some other tactics to intimidate or show off their strength. These rituals serve as very reliable proxies to ass's relative strength. Most of the time, one of the stags decides to back out based on how he assessed his opponent's strengths during these fake fighting rituals. As a result, very few duels actually happen. The proxies are not accurate. There is a good chance that the stag backing out could have won an actual duel. But the stags prefer to make the type 2 error while avoiding type 1 errors at all costs. They won't fight unless they are very sure of winning. They end up losing out on many mating opportunities. But the rule in the red deer world is very clear. Avoid any risks to limb or life at any costs. These rituals and rules, which are an evolutionary development, have helped the red deer survive. Other species which haven't followed this survive at all costs dictum have gone extinct. The answer for the investor is the same. Avoid type 1 errors at any cost. There's also a mathematical illustration of this point for those of you who aren't convinced by Darwinism and needs a rigorous proof. Assume there are 4,000 investment opportunities in the market, out of which 1,000 are good ones. There are two investment strategies. In one, the investor invests aggressively and makes more type 1 errors, makes a bet on a bad business 20% of the time, and make less type 2 errors, doesn't make a bet on a good business 10% of the time. In such a case, what is the probability that if they make an investment, it's a good one? Success probability equals good investments / total investments, good plus bad, equals 1,000 * 90% / 1,000 by 90% plus 3,000 * 20% equals 60%. Explanation: 90% times invested in the 1,000 good businesses and 20% time investment in the 3,000 bad businesses. In the second strategy, the opposite happens: conservative investing by reducing type 1 errors or fewer bets on bad businesses, 10% of the time, and more type 2 errors or missing out on many good investments, 20% of the time. In this case, the success probability changes to success probability equals 1,000 * 80% / 1,000 by 80% plus 3,000 asterisk 10% equals 73%. Now imagine a third strategy, where both types of errors happen 20% of the time. Success probability is now equals 1,000 asterisk 80% slash 1,000 by 80% plus 3,000 asterisk 20% equals 57%. Two clear observations. 1. Even an investor who is able to correctly bet on good businesses 90% of time makes only 60% good investments because of their bad bets. 2. The power of the risk aversion philosophy is very clear. Decreasing type 2 errors by 10%, strategy 3 to strategy 2, increases your investment success by only 3%. But reducing type 1 errors by 10%, strategy 3 to strategy 1, increases your investment success by 16%. It's very clear that investment success comes from avoiding type 1 errors as much as possible. You are better off being highly selective in your investments to avoid bad bets, even if it means losing out on good opportunities. So how does Nalanda reduce type 1 errors? By eliminating the known avoidable types of risk. Pulak lists the types of situations that he avoids at costs. Avoid promoters who don't have a clean record. He only invests in companies where the promoters have the highest integrity. Avoid turnaround stories. Detesting debt. Avoid highly leveraged companies. Avoid companies which have a propensity for mergers and acquisitions. Avoid rapidly evolving industries. Avoid misaligned owners, government-owned companies, Indian-listed subsidiaries of global companies, Indian conglomerates. Part 2. Buy high quality at a fair price. In this section, Prasad introduces the second of his 3 mantras of investing: buy high quality at a fair price. He argues that the key to successful investing is not just about buying any stock, but about buying high-quality businesses at a price that is reasonable. Prasad defines a high-quality business as one that has a sustainable competitive advantage, strong management, and a track record of generating high returns on capital, ROCE. He emphasizes that such businesses are more likely to grow their earnings over time, providing a compounding effect that can lead to significant wealth creation. However, Prasad warns that even the best businesses can be a bad investment if bought at too high a price. He advises investors to be patient and wait for opportunities to buy these businesses at a fair price. Prasad uses examples from his own investment portfolio at Nalanda Capital to illustrate this principle. He shares stories of how he was able to buy shares in high-quality businesses during market downturns or periods of temporary uncertainty. The general principle is that by waiting for the right opportunity, investors can buy shares in high-quality businesses at a fair price, leading to long-term success. This strategy is akin to the survival strategies of species in the wild, where waiting for the right opportunity often leads to better outcomes. High ROCE. Consistently high ROCE, greater than 20% over 5 to 10-year period, business is likely to be run by an excellent management team by focusing on earning maximum operating profit per unit of capital employed, delivering superior quality products compared to competitors, attracting and retaining quality employees, maintaining quality balance sheet, continuously innovating by taking calculated risks. Business robustness. Business must be robust to evolve. A robust business will fall between the two with more tilting towards the left. Waiting to buy at fair price. Businesses with low level of risk and exceptional business quality will almost never be cheap since market is almost always efficient. Therefore, wait for the opportune moments to come to buy at fair price. Investment success versus business success. Investment success may not correlate with business success in short term due to price movements caused by proximate noises which are divorced from ultimate business success. Proximate macroeconomic causes might not affect business in long run, but stock prices can react to them. Study companies' fundamentals to avoid this pitfall. Proximate market-related causes are unknown and unknowable but still affect stock prices. Market forecasts are usually wrong. Proximate thematic causes lead to high interest and pump up stock prices. These causes have following characteristics. Hyped up total addressable market, TAM. Every layman understands this business even without studying the business. Actionable i.e. you can invest in that theme. For example, crypto, NFT, stocks of specific owner. Themes are not bad, euphoria around them is. You can avoid this pitfall by checking interest level by simply using Google Trends. Proximate causes that are company-specific are trickier. Check if the proximate cause is permanent one. See if the company is consistently losing market share over a 3-year period. Global events can affect stock prices of great businesses but not their business strength. Thus, study business fundamentals that lead to ultimate business success instead of news. When proximate causes are divorced from ultimate causes, markets can offer great business at fair prices. Opportunity cost of not investing in troubled period far exceeds any near-term pain owing to notional loss. Historical data versus projections. Focus on historical data instead of mindless projections of future cash flows. Valuation should be the last step with least amount of time spent. Giving weight to historical data is necessary, but it is not sufficient. See how the competition has evolved today as compared to past. How the company has created the moat. Giving weight to historical data has two downsides. We assume historical performance will continue. Failing business will continue to fail. This will lead to missed opportunities, but there is no way out. Handicaps of discounted cash flow. DCF becomes handicap due to discount rate. Beta is derived from price and thus it is flawed. Risk premium is based on opinion of other market participants. Higher debt brings down cost of equity, but in reality market pays higher multiple for debt-free companies. Value of cash flows at PV is sensitive for every 100 BPS. Cash flow projections. Company's management itself cannot project the future outcomes properly, so what makes you think your Excel model will give correct values? Business convergence. Convergence in business symbolizes that there is a pattern to success and failure. Principles of convergence in business. Buying a business = buying a share in industry. If the industry allows companies to make money, then look at the industry, else avoid. For example, airline, telecom businesses have failed on long-term. Actual investment decision will be based on company-specific factors such as valuation, risk, management, etc., and not on industry-specific factors. Convergence will tell you that only select companies make money in a specific industry, so look for undisputed leaders. Don't apply principles of convergence to new and emerging industry. When market dynamics like local law, culture, etc. are not like international peers. Signals from company. A dishonest signal is one where the signal may not communicate what is supposed to be. Thus, assign very low weight to such signals. Companies relay signals in the form of press releases, con calls, media interviews, analyst meets, annual reports, dividends, buybacks, exchange filings, etc. Lend credence to only signals that are costly to produce. Broadly, there are only two such signals. Historical financial data, since it has happened, an undeniable outcome of companies' actions and outcome. Channel check on reputation in industry, since it takes years to build good reputation. Talking to customers, dealers, competitors, ex-employees, suppliers, industry experts, etc. can provide holistic view of the company and its industry. Business versus stock price. Short-term price fluctuations are inevitable and appear greater than the change over a long-term period measured in years and decades. Stock prices change on every tick, businesses don't. When you find high-quality business whose fundamental characteristics are not altered, exploit short-term fluctuations as a buying opportunity. Avoiding bad businesses. Probability of bad businesses becoming good is very low. Best way to avoid bad businesses is to avoid looking at stock prices. Thus, as an investor, it is better to have business knowledge instead of stock price data. Good businesses buying and selling. Buying at right price is better than buying at right time, since you will never buy the exact bottom. The bigger mystery of compounding is not that it leads to large number, but it doesn't do anything for a long period of time before suddenly showing an exponential growth. Great businesses with high PE can give surprise through expanded earnings. Good businesses usually trade at higher PE and thus remain unbuyable for most of the time. Any drastic fall in PE only to market risk, things unrelated to companies' fundamentals, should be exploited as an opportunity to buy these good businesses. This punctuation period, milestone, to buy good business is only 1 to 2% of the long period measure in years/decades. As long as these businesses keep gaining market share, there is no reason to sell. High-quality businesses should be sold only when there is decline in corporate governance standards, egregiously wrong capital allocation, irreparable damage to the business. Reasons not to sell great businesses. Billionaires are owners of the business and they didn't become one by selling their shares. Empirical data suggests holding great business pays off. IRR can mislead. Instead, see how much money multi-baggers have made in proportion to potential capital loss due to poor performance investments. You can benefit from compounding only if you hold on to great businesses. Spend energy on buying decisions instead of wasting on selling decisions and later on regretting on opportunity loss due to selling decision. Investing well. Focus on investing well instead of making best investments. Investing well is a process. Most investors don't fail due to wrong models but due to failure to repeatedly pursue a great model. Part 3. Don't be lazy, be very lazy. In this section, Prasad introduces the third of his 3 mantras of investing: don't be lazy, be very lazy. This might seem counterintuitive at first, but Prasad explains that in the context of investing, being lazy means being patient, not rushing into investments, and taking the time to thoroughly research and understand a company before investing. Prasad argues that many investors make the mistake of constantly buying and selling stocks in an attempt to time the market and make quick profits. However, this approach often leads to poor investment decisions and unnecessary transaction costs. Instead, Prasad advocates for a lazy approach to investing, where investors spend most of their time researching and understanding businesses, and then invest for the long term. This approach requires less frequent trading, hence the term lazy, but it often leads to better investment outcomes. The end. Thank you for watching. Please subscribe, like and share. See you in next video.